Good afternoon and welcome to the panel on tokenized private money. Welcome also to those watching online. So thank you for the warm welcome. My name is Joasia Popowicz. I am Associate Editor at Central Banking. And I am pleased today to be joined by Dante Disparte and Umar Farooq. Dante Disparte is Chief Strategy Officer and Head of Global Policy at Circle. And prior to joining Circle, Dante served as a founding executive of the Diem Association, which was a blockchain payment system proposed by Facebook, which met regulatory barriers before abandoning its stablecoin Libra. And And Umar Farooq is the CEO of Onyx by JP Morgan and the Global Head of Financial Institution Payments. So Onyx, launched in 2020, is the first bank-led blockchain for the exchange of digital assets, which are settled using the JP Morgan coin, also a stable coin. JP Morgan reports that it has over 40 participants on Onyx, including large broker-dealers, and processes up to around $2 billion daily. So Circle manages USDC, which is a stablecoin pegged to the dollar, used on over 16 blockchain networks, with a reported combined daily trading volume of around 680 million on primary and secondary markets. So just by way of brief background, we've talked about tokenization today, so it's the digitization of claims on programmable platforms. Believers say it will revolutionize the financial system. However, given there are problems in decentralized finance, such as stablecoins losing their parity with the dollar and a lack of transparency around reserves, as well as, of course, crypto's notorious volatility, could tokenized bank deposits meet the needs of an evolving financial system? So these are some of the questions that we're going to be exploring today. So I wanted to start with you, Dante. What form and what role do you see for tokenized private money in the future of money? And what changes do you think might be needed to digital financial infrastructure?
Well, first of all, it is a real pleasure to be on the stage and to have been invited into the inner sanctum here at the Bank for International Settlements. So I guess I would start with a speech by a central banker as a way of answering this question, which is Sir John Cunliffe, who was one of the contemporaries at the Bank of England when the now infamous Libra project was launched, later referred to the project as a warning sign to central banks and banking more generally, and referred to Libra as black ships on the horizon. And as a captain of one of those black ships, and despite the fact that we never quite found safe harbor, but nonetheless, I'm very happy to be on the stage. What I can say is that the vision and the business model in many respects is vindicated by a couple of things. And that's perhaps the experience of a company like Circle and the many debates that Umar, Farooq, and I have had around the world, is that convergence is the better outcome of this technology rather than disruption. So when crypto first emerged on the scene, it was in the smoking crater of the 2008 financial crisis, and it was supposed to be an anti-establishment technology. And what we have seen, though, is that in the United States, the digital asset industry is heralding the advent of tokenized money market mutual funds from none other than Wall Street entering the market. And at the same time, as you probably hear from Umar and I, while we have had several debates around the world about tokenized deposits or payment stablecoins and which business model would be the best, the fact remains is that the closer these products and services get to central banks, the better they will be to fulfill the unmet needs that the central banks themselves, we heard this morning, are trying to achieve. Universal financial inclusion, relevance in the 21st century and beyond. Your and my financial needs don't take a bank holiday, but if to be banked hinges on brick and mortar, we all have a problem. And I think that's the key for me. And perhaps the last quick point I would make is definitionally the only admonishment I would make to the central bankers in the room today is we have to update the definition of what does it mean to be a bank. Because all too often the provision of these innovations in financial services through the two-tiered banking system precludes the participation of regulated non-bank actors who could either provide critical technology or critical capabilities like a company like Circle could in this common objective of upgrading the modern economy and the financial system. So I bring an olive branch and a message of convergence as opposed to disruption.
Umar, question to you. So similarly, what roles and what potential do you see for tokenized deposits and stablecoins, and what are your views on the optimal future state of digital money?
So first of all, again, thank you for having me. I will also start with a Libra-related story, which is I was here in 2019, I believe, and the Libra team and the JPM Coin team, and I think Finality team were invited to speak about the respective projects. And I remember it was a bit of a strange format because each project got to go separately into the room. It was sort of like, being on trial. And I remember the Libra team going in and not coming out for a long, long time. And you're like, I don't know what's going on in there. But, but then I went in after, and there was some fear in the system. But now, it seems like the fear has been dissipated. So again, I actually would fully agree with Dante, which is, I think whether it's convergence or coexistence, you can't, it's not an either-or proposition. So at the end of the day, leaving aside digital currencies, if you just look at money in general, you basically have central bank money, you have commercial bank money, you have private money. There's all different tiers of money, and people in this room, most of them are very familiar with that infrastructure. So if you think about even in the US, for instance, you have obviously the dollars that the central bank issues. Then there's commercial bank money, which is JP Morgan, Bank of America, and all the thousands of banks in the US. And then there's things like Venmo and PayPal and all that, and that's also, or Apple Pay. I mean, that's also money. That's a different tier of money. I would argue that most of these not only coexist, but they actually slightly serve different needs. They have different levels of innovation and different use cases, so they all should be able to exist. I think where we will diverge a little bit is, I think you also have to keep in mind that you do not end up creating regulatory arbitrage in the system. And what I mean by that is, if you want to move a dollar from, say, New York to some other location around the world, there is a lot that goes into that process, and a lot of that is because of legal and compliance and all of those things that we have to do. I think as Project Mandela was presenting, you kind of those are some of the issues that are being resolved. And I think if you think about sort of whether it's crypto tokens or stable coins, when they are moving around, in many cases there are folks. I mean, I think actually I respect the Circle team quite a bit. I think they've really thought this through, but there's lots of people out there who are moving this with, frankly, no oversight. And it's only a matter of time before something really bad could happen, and that would have an impact on the entire system. So I think you have to really think about two things. One is reg arbitrage, which is how do we avoid that? I think a part of that is obviously regulatory clarity, as in what is this exactly? And then also, I think, as Dante said, yes, I mean, you can get closer to the central bank, but I always think of the central bank as, sort of the closer you get, the more highly regulated you become, because the closer you are to possibly blowing up the entire system. So you need to make sure that no matter how close someone gets, they are being held to the same or at least similar standards. So I think that's one thing. I think the other thing which I would say, based on all the stuff that was said so far, is you do need to separate the technology from other aspects. So there's a technological aspect that could solve things like, inclusion. If people don't have access to a digital means of money, yes, introducing one from a central bank, especially in an underdeveloped economy, could have a significant impact on inclusion. However, I think you have to separate that from what is inside it. So why people might want to hold a stable coin or even crypto in many countries is not because of the technology, but because of the access to hard currency. So, if you really think about it, many countries, if you are sitting in a country with extremely high inflation or hyperinflation, you don't want CBDs, you don't want, Circle or USDC or any of these coins because you think the tech is cool. You want them because you're getting USD. And a lot of those, governments, central banks may not want that. So I think a lot of these issues have to be resolved, and you have to separate those two, because sometimes we end up conflating them.
Great. I should also mention that the format for this session is slightly different, where we will actually have a chance for audience questions. So please do have a think about what questions you might want to pose, and hopefully we'll have a lively debate. So moving on, Umar, I wanted to follow up and ask, so what with regard to interoperability, what challenges are there of digital money between tokenization platforms and traditional finance systems, and how can these be solved?
So I would take them a little bit differently, which I think as you were going through, or Dante, whether you were talking about it, there's more than a dozen blockchains that USDC is available on. I think it's actually a common misconception by people who are not close enough to the ecosystem that they think that there's like one big thing out there, whether that's Ethereum or whatever. In reality, there's lots and lots of chains, and it's still unclear how many of them or which of them will actually emerge victorious. You could argue that Ethereum would be one of them because it's very big right now. That's why a lot of the project, including Enbridge, uses EVM compliant. We do EVM compliant stuff. But that doesn't mean it's going to win. I mean, there's them, there's Aptos, there's Solana, there's Polygon. You can just go on and on. And so there are proven technological means to make them interoperable. They're all ugly. Like every single one of them has friction in them. So I think actually, if you really want to do transactions across them, you have bridges, et cetera. And frankly, if you go back and read pretty much all the cyber incidents that have happened, attacks as well as compromises, they almost always happen at that seam when two systems are trying to talk to each other because you create these very attackable sort of frontiers at that point. So I think that's one, which is just technologically there's ways, but nothing is perfect so far. The second thing is actually interoperability between that and the traditional financial system. That is a harder problem to solve. And for us, we run a blockchain infrastructure that, again, moves billions a day, but not trillions that we move in our regular infrastructure. And that talks to our traditional infrastructure, which is core banking, our general ledgers and things of that nature. That is a tougher one to solve because most of these core infrastructures neither are performant at the same level that blockchain is in terms of how much transaction you can push through and how quickly it happens and how settlements work. And also most of them are not 24/7. So most of them have cutoff hours and they might be 5 days or 6 days a week. And so how do you actually make two things talk to each other when one of those things is off for a certain amount of time, but the other thing stays live is a real technological as well as legal problem to solve. Even something as simple as value dating, which again, people who want to get really tortured by banking can really read about and think about is, what happens on a Monday? Did the transaction happen on a Monday or a Sunday or in Singapore or in New York? I mean, all these things get very complicated. So I think, again, we will get there one day, but for now, these are mostly issues that are somewhat unresolved. So, we basically do it by making sure that the two layers are synchronized at some interval, that the total is always synchronized in real time between the two. But if you really think about, let's say JP Morgan and Bank of America both had the equivalent of, we had JPM coin and Bank of America had, Bank of America coin, I'm just making it up. To settle those two is actually a real complicated endeavor without having either a real-time ledger at the back, a wholesale CBDC at the back, or a 24/7 RTGS system. So again, all of these things have to be resolved. Again, you heard that, especially from the Swiss National Bank. I mean, a lot of these things are being worked on, but these are tough problems to solve even within a commercial bank, let alone going to the central bank infrastructure.
Dante, so going to you, we've heard a bit about the problems. I'm just wondering what kind of innovation you're expecting to see in the space for the rest of this year and early 2025.
Yeah, I think, ultimately, I can't help but put the mirror and hold the mirror up because the audience represents one of the most critical stakeholders that really matters for the innovations that we all care about, which is that we talk about technology neutrality, activity-based regulation. But what I think the last 5 years in this industry has witnessed amongst many policymakers is the permission versus forgiveness tension always gives out. And that has precluded many countries, many banks, and many central banks under the guise of protecting their economies and the banking system from spillover risks, from actually witnessing this constantly upgradable financial market infrastructure that Umar just rightly described, right? That instead of having a standards war that caters to closed, walled garden payment systems, the world has enough PayPals. If you were lucky enough to be born in the right postal code, you have access to a comparatively fast payment system. But then there's a whole portion of the planet that if, again, to be banked is about brick and mortar would be on the edges, those technologies are actually patently easy. And actually, we should all be grateful for the fact that they're proven to be constantly upgradable. Public blockchain infrastructures collectively have ledgered trillions of dollars of economic activity, and it proves that it in fact works. The industry and the technologies have also solved their mini Y2K moment with the Ethereum merge to move to proof of stake over proof of work. The question, though, is to many an industry player, they've learned the hard way that the central banks and the regulators have infinite authorities and no statute of limitations. But yet we have not encouraged broader cross-sector collaboration that includes non-bank actors. That's the key theme, because I think the tech works. Digital wallets have enabled stablecoin transactions in more than 191 countries in just the case of a company like ours. And what we've also proven is that this is an imminently partnered business model, that the value chain of digital assets and therefore the value chain of tokenized money presupposes complete interoperability under the watchful eye and invisible hands of central bankers with the prudential risk management that you get from the banking balance sheet. But there's some risks there that go both ways, as we learned about in the United States and you learned about here in Switzerland with Credit Suisse. You wouldn't want a deposit token, for example, issued from any one of those banks that recently failed. And then lastly, you ultimately want this last mile to overcome the walled garden problem that we have in payments, which is that a fast payment exists to the extent you're lucky enough to be inside the walled garden. But if you want a fast payment at the extent of world reach and world scale, you actually need to use open systems from end to end. And all of those open systems can be a reflection of a prudentially managed structure, which I think we've proven.
Okay, great. I'd like to open it out to audience questions. So just looking at around the room, we've got a hand at the back. Is there a mic? Yes, great, thank you.
Hi, thanks. Mark Staples from Australia. This morning, Thomas Jordan from SNB talked about a form of private money that was a kind of alternative to CBDC. It was a reserve-backed digital currency, but a privately issued one. But he said it could be bankruptcy remote. So I'm curious if you have any thoughts about whether or not it's important for settlement instruments to kind of be bankruptcy remote, in the sense that they survive the bankruptcy of the bank that's issued them.
I think at the end of the day, I think Dante made that point. I mean, there's good guys and bad guys, and banks that are prudently managed and maybe they're not, and you can fail. I do think, though, there are certain kinds of instruments that need settlement in central bank money. And if those instruments are being created, you can do them through how we do them today, or you can do them through what was discussed earlier in terms of a bankruptcy remote structure. I don't think that's an exclusive one, though. At the end of the day, most transactions are happening in commercial bank money. And so even though, to some extent, yes, I mean, has there been failures? Yes, there have been failures, and for better or for worse, most of the people in the failure were protected. I mean, you can argue that, in many different ways, obviously. But ultimately, I think that has to be one of the options on the menu. So the way, again, I think about this is you have a commercial bank option on the menu. You could have a stable coin or some other kind of private token option on the menu. You could also have a central bank CBDC or a bankruptcy remote infrastructure. I know Finality is somewhere in the room. I saw Ram earlier. I know they are trying to do something very similar. So again, I think there's all these flavors of money, and it will depend upon what the use case is, because people might prefer a central bank option or a commercial bank option for the kind of transaction they're trying to do.
Yeah, and the only additional point I would add to that is law matters more than technology. I think we heard that in the earlier panel for sure. In the US dollar, it's emblazoned with the words "In God We Trust." To the crypto utopian or anarchist, "In Code We Trust" would be their their public declaration. But it all turns out that unless you can enforce that upon the issuer and the holder's rights are preserved in some manner, then it may be meaningless. Just as we have money that isn't worth the paper it is printed on, we have had in this industry many, many, many tokens issued with no worth whatsoever. And so one thing that is encouraging, of course, is around the world, most major economies have rules that enshrine in law. For example, on the other side of the Swiss Alps in Europe, under MiCA, an e-money token has certain treatment and certain classifications that in some ways are even more conservative than banking. In the US, the draft legislation for stablecoins would require that a bank that issues a stablecoin do so from a different balance sheet than the banks to not subject the stablecoin to asset liability mismatch. I think these developments are much more encouraging than what you would see in the tech alone.
I've got a hand in the middle here. I've got a few hands actually, which is great to see.
Thank you. In terms of the inclusion, what do you think needs to take place to onboard the next billion people in any kind of commercial transactions? And maybe second thought, what could this audience or these institutions here, the traditional ones, make to enable it?
Sure. I mean, I'll start with a joke. I tried. I had a couple billion users with Libra, but
I know, and I support it.
I joke.
Yeah.
Exactly. Next year I'll sponsor the conference. No, I think the good news is about the financial inclusion use cases is it actually analogizes quite powerfully to the way we have seen the decoupling from fixed line telephony to mobile telephony, is that there's a user base that would not have been achievable to service if the infrastructure stayed exactly the same. And I think we see analogies very, very similar to that around the world. We also see, frankly, that there's a developer ecosystem in the current iteration of this industry that is building the infrastructure to reach the end user and to reach the last mile in very encouraging ways. One of the most powerful use cases we know about and we've partnered on was, of course, with the United Nations High Commissioner for Refugees in Ukraine to deliver digital disaster assistance in a situation where the actual physical infrastructure and the banking infrastructure ceases to operate or is in the wrong hands. You now have this optionality in the payment system that I think is a really crucial part of the conversation.
Yeah, I would only add, I think, again, coming back to my point of separating the tech from the underlying currency, et cetera, I do think you run into the reality of how money works in the world. So there are big economies that obviously want to control their own monetary policy. They want to control what access people have onshore in terms of currency. There's capital controls and all these things. So yes, I mean, you could onboard using technology, a lot of people, or if you're in a Ukraine or any other war zone, yes, everything's collapsed. So you need something, and this technology could be a good way to get it there. But if you wanted to onboard 1 billion people, I would still argue that if you're operating in a world where the currency of that specific country issued by that, the central bank of that country is paramount and is part of their law, governance policy, et cetera, you always will see probably a bigger take-up with the likes of a UPI or other infrastructure like that, a centralized infrastructure being pushed down versus not. I'm not arguing that's a good thing or a bad thing. It's just that's the way to do it. I mean, I think India has written a chapter on that using actually public infrastructure. China has written a chapter on that using not non-public. So I mean, again, if you look at China over the last few decades, I mean, they leapfrogged using Ant Financial primarily, which is a private institution. So again, there's ways to solve that issue. Trying to do it through a distributed ledger at a retail level, it's very hard to disaggregate that from the monetary policy.
I've got a question on the end over there.
Thank you. Brian Zhang from the Cambridge Center for Alternative Finance. So the concept of UniFi Ledger has been mentioned several times at this summit. I wonder what the panelists think about this concept and what forms of digital money should UniFi Ledger include and why? Thank you.
So I think, first of all, because Mr. Carson is sort of the resident host as well, sort of from the country, we have to like unified ledgers. But in all honesty, I think you almost need something like that. I mean, it's actually almost a necessity because if you look at the public, and I'm sure this is one Dante and I will disagree on, but if you look at the public blockchain ledgers, they are not fit for purpose for large transactions today. And I'll tell you why. Let's say we were doing a transaction worth $100 million, and we were sending money, 100 million, let's say ourselves and UBS, just making it up, the two banks. If we are sending 100 million to UBS on Ethereum, there are validators who are validating the transaction. Now, what if something goes wrong? Who do I sue? I mean, you can trust and code all you want, but you can't really go to there's no court where you go and really have a discussion. And you need those sorts of backups. If someone loses your coat, but you still have the ticket, you want to be able to call someone at the end of the day saying, what the hell, you lost a very expensive coat. So I think at this point, maybe public infrastructure will get there one day with things like verifiable credentials, but that path is far away. And you need to get somewhere where people can do trusted transactions between financial institutions with some sort of accountability in the system. Whether that happens through unified ledgers or otherwise, it remains to be seen. But frankly, unified ledgers, RLN, Mbridge, they're all trying to do this. Frankly, we have another project going on called Global Layer 1 at the MAS with Citibank and others. So they're all sort of shades of the same thing, which is you need some sort of a regulated financial infrastructure, and that financial infrastructure should be open to public institutions like central banks, should be open to private institutions like banks or non-banks. I mean, it should be the world's global layer for money movement. Otherwise, you just will always be in this thought process of being in silos. Not to mention, I think all these silos have native tokens, and I won't even go there. That's a whole different issue as well.
So I have to start with a small joke, which is that it looks and feels a little bit like Libra. I
think you should stop mentioning Libra.
Look, I figured I'm going to own it. I'm teasing. But now the serious comment, of course, is that the idea makes a lot of sense. But in my humble opinion, I think oftentimes we're going for marginal improvements on things that already have all kinds of institutional advantages. And the only reason you don't move money any faster, arguably, is either because of a lack of will or because it's a pathway for monetizing speed. Speed in the banking system is a premium service. I pay people to get out of money faster, but I still can't execute a transaction on nights and weekends and in bank holidays. The other thing that a unified ledger conversation almost entirely ignores is geopolitics. You don't weaponize a currency, you weaponize the rails on which currencies ride. And I think all too often, while the central banks are doing really the Lord's work in figuring out how to modernize payment systems and money, the geopolitical reality is cross-border payments integration of this kind is often a line too far for national security interests. And that's the unfortunate piece of the puzzle.
Gentleman at the front.
Okay, we see the future as a sort of a struggle between, on one end, the idea of regulation and control, and the other side being placed by innovation. If you could take out a crystal ball here, what would you say would be the balance point that you would expect to see in the next decade, for example?
Yeah, it's a very good question. In the next decade, my sincere hope is that we're no longer talking about the technology. You know it's still early when you're still describing the technology and the technology as a protagonist. When was the last time we all went to an internet-related conference and spoke about hardware and software and the routers that make the internet possible? It's faded into the background, not dissimilar to cloud computing. Cloud computing, when it first became a thing, was terrifying to IT departments whose job security depended on keeping the servers plugged in and occasionally updated. And then all of a sudden, this core infrastructure becomes universally accessible, almost indispensable to both public and private stakeholders. And it's now a background technology. My sincere hope is this same future of money, digital currency conversation becomes background and what people care about most, and where I think the central bankers have the biggest stake, is outcomes. Our payment systems are slow, they're sclerotic. In past debates with Umar, we've had the displeasure of being at opposite ends of each other. I won't say who won those debates, but there's a video on the internet.
The second one.
Round one, he beat me.
Yeah.
But luckily, that video doesn't exist. It was all Chatham House. There's a whole host of things that we simply cannot achieve if we keep using the same analog infrastructure and all of the rest. And so I think we're still in the zeitgeist phase of the tech being the protagonist. But soon enough, 5 years from today, you'll have open public blockchains with Visa-scale transaction throughput. And therefore, the end user wallet experiment will be tech neutral. It'll be the activity that matters most. And I think regulators, policymakers, and central banks will be very well served in regulating the activity and not the technology.
I would agree. The only thing I would add is I think they need to become true public goods to be seen that way. Yep. And the reason we are stuck in technology is not just because we are early, but there's a stake that the technology owner has. Again, coming back to the token issue, which is I have a blockchain, my token is ABC. I really want to attract everyone to my blockchain because that's how my token goes up. So I think while tokenomics is an interesting concept, I think the core of tokenomics also makes it very hard to converge. I mean, think about it. I mean, the internet was developed as a public good. Now, it came out of all kind of military research out of some universities, but right now, no one really thinks about the price you're paying for an email you're sending. There's something in the back end, but it's a very minimal price. So I would argue, I mean, with all its flaws and positives as Swift, CLS, like a lot of these infrastructures that are gigantic infrastructures are actually seen as public goods, same for RTGS systems. So I think we need to get to an evolution point where the technology starts to be seen as a public good versus as a means to enrich, the group that sort of, owns it but doesn't own it because code is paramount, but then there is humans who are making money from the code. So, yeah.
Okay, gentleman here.
Regulatory arbitrage was mentioned, different tiers of money, attacks happening at the bridge, closer you get to the real thing. It seems to me that there might be ways in which we could rethink the ways in which we think about systemic risk. Is that where we're going with this, and how should we start rethinking that?
Yeah, it's a very good question. Because of course, as much as it, and hopefully the convergence message that I started with resonates still, otherwise it'll be a very lonely happy hour for me at my hotel. The question of systemic risk in the space is a very, very real issue. Just look back at the last couple of years. In the industry, they call it an ice age, a winter, I call it an ice age, right? In the last few years, the industry lost $2 trillion. This is just in digital assets. Most of which were not losses necessarily triggered by the technology, but by good old garden variety fraud and arbitrage and race to the bottom behavior. And the actors that have had the exact opposite operating models, hence the message about activity versus technology, have weathered the storm comparatively well. And where we now see the new version of systemic risk emerging is actually in the domain of bank to non-bank convergence of risk. And so my message to unfinished regulation and lawmaking is we have three choices left, particularly in the United States. Regulate, legislate, or designate. And in the designate category, you could either designate actors or technologies in the space as systemic or as national security threats. And we've seen precedent for both. But what's clear to me is that the more you get this within the perimeter, within the purview of central banks, and clearly articulating the line where fin ends and tech begins, the better. The better for outcomes, the better for markets and all participants.
Yeah.
Following on from that, actually, I'm just wondering what limits do you both see to minting JP Morgan coin and USDC with respect to financial stability?
I mean, we don't really mint because we effectively are operating a deposit at JP Morgan, which is general liability. So, it's the only cap is how much my internal treasury team would let me do, which is quite a high cap. But, and again, it's an interesting sort of, similarity, which is it is a deposit, so it's no different, but I still have a cap designated by JP Morgan Treasury and CIO, primarily because they are like, this is new technology. So I think that's why I think we increasingly need to get away from the technology debate into what this thing actually is. And I think it also plays back into the previous question, which is, we've had, I think getting into some sort of perimeter somewhere is very important, in or out, because we are operating in a bit of a gray zone, and so those usually don't play well in the long term. If something goes wrong, like it did with FTX, et cetera, I think people had differing reactions. I mean, one is we could have probably overseen it, and we could have probably had consumer protections around it, and maybe that wouldn't have happened, or maybe it would have happened because even banking has problems like that. Or, the other approach which many people took was like, see, we protected the entire system from the meltdown. So again, I think, we need to think about what choices we want to make here.
Yeah. I won't ignore the minting question, but I would just say in hindsight, a market regulator telling consumers to put on their seatbelt after a crash is like the plane crashing and the captain putting on the seatbelt sign ex post facto. I think minting of a market-facing payment stablecoin, which is what you would call USDC in the United States, or an e-money token in Europe, is actually a market-driven activity. And so that's one point, meaning I don't think of these products as competing with the deposit base of banks at all. The second really critical feature of stablecoins as payment innovations is that even a comparatively small total circulation can support a lot of economic activity. And so the upper bound, in my opinion, is perhaps in the hundreds of billions of dollars. We already see that today. The question is, how much of it ever comes on shore inside the currency zone or jurisdiction of which the stablecoin references? That's the really critical next step in this industry. And then the next piece of the puzzle is the degrees to which it is banked and the degrees to which it enjoys proximity to the central bank are the next two big policy questions in my mind.
I think we have time for maybe 2 or 3 more questions. Oh, was that? Yeah, please. Would you like to choose somebody? Well, 2 hands at the back would be great.
A short question. My name is Amna Samid. Do you think people will be willing to pay a fee for having private, anonymous transactions with private money? 1%, 0.5%, 2%?
I mean, so anonymous is an interesting word.
Up to some threshold,
Yeah.
I mean.
Yeah, I mean, anonymous was thrown around a little bit, here as well, which is, I mean, cash is anonymous, but cash has also got like very strict limits. At least for most developed economies, what you can do with cash is pretty much limited in terms, even going in and out of the bank. So anonymity is a pretty limited good. And if someone wants to pay a bunch of money for a large anonymous transaction, I'm really not sure that that's something we should be encouraging anyway. So I think, from my point of view,
Small amount of money. I want to buy,
The one thing, the one
buy
thing I
flowers
would
to buy mistress. I want to do it
the one thing I would say,
No,
I agree with Umar entirely that if you need to spend a lot of money buying anonymity, we ought to do some other checks on you. But the one thing I would say, is the air gap between the central bank, the banking system, your wallet, and how you spend your money is a feature, not a bug. And we ought to really preserve that. And I think most of the Western world and the democratic world CBDC conversation has actually not been hung up by the technology debate. It's been hung up on the societal presumption of privacy debate. And therein, I think we have some really critical boundaries to continue discussing. Just because I nearly launched a project with a white paper doesn't mean that every central bank in the world has to compete with their high street banks and how you spend your money. I think those boundaries really do matter.
Okay.
So lady
Thank
at
you.
the back, and then afterwards the gentleman in the blue suit. Far corner.
all the way over there.
Yeah.
Throw the mic.
Thank you. Dante, now I remember where you were. Appreciate the reminder. I'm Melissa Coity, and I wanted to follow up on the financial inclusion question and also your response to it. Globally, right, a little less than 2 billion people can't be identified. And that sort of front end, are you who you say you are, is a tremendous challenge. You were then referencing, I think, additional data that can be used and brought to bear for KYC purposes. Yet at the same time, we're having a really big debate about consumer privacy, to your point. Yeah. And in the US, we're seeing this begin to come to a head. What kind of data can be used for not just, an underwriting decision, but also fraud, AML requirements? And I'm curious how you all think about that, both that challenge, the opportunity from an inclusion standpoint, and how do we really engage in a debate and an opportunity for leveraging data so that we can bring more people into the financial system, but yet mindful of so many of these deep privacy expectations. And by the way, I have always thought Facebook's Achilles heel was the fact that they have all the data and the ability to really do identification well. So maybe over drinks we'll talk about that more.
Maybe I'll start, and I won't comment on the Facebook angle. I'll let you do that. But I think on the KYC front, just sticking with the US example, there's people who are riding around bicycles in New York City delivering food, and they cannot have bank accounts, not because they can't afford one, but because they're actually not acknowledged as existing in the US. So I think there's, and that's we are talking about one of the most advanced economies, and I think the issue there is not a technology issue. The issue there is a political issue, a legislative issue, whatever you want to call it. So I think when it comes to financial inclusion, for many parts of the world, these similar issues pop up in terms of legal, where the tech it might not even be anonymity. I mean, the person may not want to be anonymous. It's just that, or maybe they want to be anonymous in case someone comes after them. But I'm saying, it's just the issues are very complex. So that's why I think my faith in the tech as being a real leapfrog in terms of inclusion is somewhat mixed when you look at the world the way it exists today.
Yeah, I would just say briefly, realizing we're nearing time, if ever there were a group of stakeholders that could actually advance the conversation to the adjacent issues, assume that CBDCs, deposit tokens, and the good variety of stablecoins all converge, then the next frontier set of questions are actually public policy questions. You could get all the decentralized identity, digital identity, on-chain attestations you want in the entire world, and often the tech proves where status quo falls short. But if the policymakers in the public sector do not accept alternatives as satisfying KYC and all these stubborn financial crime compliance requirements, they're important, but they're stubborn, then we will continue living in a world where so many billions of people will be relegated to the financial shadows. And so I think the tech can show what's possible, but unless the tech plus public policy, I don't want anybody to get agoraphobia in the room. So as these efforts from the BIS are announced, I would encourage a bigger tent and a wider tent that includes non-bank actors as well, because it's an opportunity to show the art of the possible.
Great. So unfortunately, we do have to wrap it up there. If you had a burning question, didn't get to ask it, I hope you'll continue the conversation outside. Otherwise, please give a warm round of applause to the two panelists today.